All right, welcome to part 3 of the chapter 3 video lecture series. This is the last part, so that's good news. This might be the only course I'm actually on time with that I'm teaching this semester. I'm behind in everything else. Okay, so we're going to cover a little bit of a mishmash of topics in this video. That's why we're just going to title it Other Corporate Stuff. Okay, so we're going to start with Code Section 195, 212, and 248. And these have to do with how you deal with costs you incur before you're actually inside the trader business. So we know under Code Section 162, we can deduct all ordinary and necessary business expenses. But that has to be in a situation where you're engaged in a trader business. What do you do with costs before you're engaged in a trader business? And the typical way to classify these is as organizational costs, as startup costs, or as costs that are neither of those and simply must be capitalized. And typically capitalized costs are ones that end up as part of additional paid-in capital, right? So they're on the balance sheet as APIC. So Section 248 provides the method by which we do this, and 195 follows the same pattern. It basically says, look, we'll let you deduct immediately up to $5,000 of your organizational costs, but whatever is left, we're going to make you amortize over 15 years or 180 months. So 248B defines organizational expenses. It says these are legal fees for the drafting of the articles of incorporation, but definitely not the cost for issuing or selling stock. So this is important in the IPO environment, where you incur quite a bit of costs associated with issuing and selling that stock, but unfortunately you are unable to classify that as an organizational cost. That's going to fall into that third category of capitalized costs. Section 195, amazingly defines how you recover these costs in the exact same way. So a $5,000 startup expenditure is immediately deductible, and then the rest is amortized over 15 years. All right, so what is an organizational cost? This is an expenditure that is incident to the creation of the corporation. So, for example, something like legal services associated with your organization, like drafting the corporate charter, the bylaws, minutes of your meetings, terms of the original stock certificates, like getting all that done. So how are you going to do that? You contact an attorney. Maybe just use LegalZoom.com. But whatever the case is, you incur these costs of organizing your legal entity. Those are organizational costs. Things that it doesn't include, which we've already mentioned, these costs of issuing or selling stock. So if you pay a commission to a broker to go out and get your, what are they called? Not syndication. Maybe it is called syndication. So go out and find all the folks that are interested in subscriptions. There we go. Finding all the folks interested in buying your stock. Those professional fees associated with going public and the printing costs of your S1, your S3, things like this, those are not part of your organizational costs. And in fact, as I said before, just become APIC. So again, the idea is that organizational expenses, even from a matching perspective, right? You'd say, oh, well, what should happen is those should be spread out over time. And when you begin to recover these costs is the month in which you begin business. And beginning business is not the same as coming into existence, right? You come into existence when your corporate charter is filed, but you do not begin business on that day. That's when you start business operations, for the purpose of which, oh man, I must be a little bit tired this morning. Or maybe I'm just listening to myself talk. So that starts when you begin your business operations, not when you're organized. So again, that mere obtaining the corporate charter does not necessarily say you have started business. That happens when your activities have advanced to the extent necessary to establish the nature of your business operations. That's when you will be treated as having started business. All right. So For a long time, you had to make an election to expense that $5,000. Now that's deemed to have occurred unless you file otherwise. So again, you are eligible to expense up to $5,000 of these organizational costs. However, this code provision was designed for small corporations, not for all corporations. And so small corporations, for the purposes of 248, are defined as someone who has incurred organizational costs of $50,000 or less during the year. So if your organizational costs are $5,000, then you can expense up to $5,000. What happens is, typical with the tax code, you don't fall off a cliff when you get to 50,001. There's a phase out. In this case, it's a dollar for dollar phase out. And then anything that you don't immediately expense, you amortize over those 15 years using what's known as the full month convention. So if you remember your depreciation, there were half year and mid-quarter. Full month means in that month in which you begin business, you take a full month's worth of amortization. So let's do an example. So V Corp incurs organizational costs of $3,000. They're clearly less than $50,000, and they can deduct up to $5,000, so they will deduct all $3,000. Let's say instead that V Corp incurs organizational costs of $45,000. Well, there's still a small business, a small corporation as far as 248 is concerned, so they can expense $5,000, but that leaves $40,000 of their organizational costs that they'll now need to amortize over 180 months or 15 years, starting in the month in which they begin business. All right, so what if V Corp incurs organizational costs instead of $53,000? $53,000 does exceed that $50,000 threshold. The dollar for dollar phase out kicks in, reducing the $5,000 of immediate expensing down to $3,000. So now there's only $2,000 left to immediately deduct. The $53,000 minus the $2,000 now leaves $51,000 to amortize over 15 years. And in our last example, V Corp incurs instead organizational costs of $60,000. $60,000 is $10,000 in excess of the $50,000 threshold, which means we have phased completely out of the immediate expensing, which means that all $60,000 will have to be amortized over 180 months. So corporations can go through a reorganization, and the reorganization could in fact create non-deductible capital expenditures. As a result, most of them end up in APIC. However, to the extent that a new corporation is created as a function of the reorg, then you would look at those organizational costs consistent with 248. And just as a side note, legal fees and costs related to organizing a corp in connection with a Type D reorg qualify under 248. Since we haven't covered a Type D's putting me to sleep. Type D, we don't need to worry about that yet. Startup costs are distinct from organizational costs. So again, these are costs that would otherwise have been ordinary and necessary, but are incurred prior to either beginning your business or the acquisition of a trade or business. So these are costs to create an active trade or business. So think of them sometimes as like advertising costs, salaries and wages for training for new employees, travel costs for finding distributors, suppliers, or customers, salaries you pay to your executives or consultants before you actually start business, and any other professional services, for example, accountants. So startup costs include investigatory expenses, right? So market surveys, understanding the business geography you might be entering into. All these things would be considered startup costs if you incur them before you are actually engaged in the trade or business. So amortization begins again, same time when the trade or business begins. So same rule when it begins to function as a going concern for the activities under which it was organized. And the rules are exactly the same for startup costs as they were for org costs. You can deduct immediately up to $5,000. There's a $50,000 phase out, et cetera, et cetera. These are not lumped together. These classifications of costs are viewed separately. So you could be deducting $5,000 for your org costs and also $5,000 for your startup costs. You don't aggregate them together to perform the tests. Okay, so before we move on, there's a distinction between startup costs and exploratory costs that we need to explore. So let's assume that Donuts R Us owns a chain of donut shops in the Northeast U.S. And DRU is considering opening new stores in Southern California. And so they send Tim, their VP of Business Development, to Southern California. And he goes and visits a number of different geographies in San Diego, LA, and Orange County. He meets with a handful of lawyers. He wants to understand, so how do California regulations around food service work? What are the zoning rules in each of these different geographies like? And maybe even meets with consultants, not a firm, but a firm, and they prepare a market study of the donut market for them in Southern California. So because DRU is already in the donut business, even if they established a separate corporate structure in Southern or in California, so they developed a California Corp, these are considered expansion costs and they're just immediately deductible. You don't need to worry about amortization or $50,000 or any of the rules. They're simply expanding. But let's say in this second example that instead Donuts R Us, same thing, donut shop in Northeast, but the CEO, Kelly Slater, loves to surf. And so she's considering expanding DRU's reach into the surf shop business. And of course, what better place to start your surf shop business than Southern California? So they send Tim into Southern California, and he does the same sort of activities, except they're associated with starting a new surf shop business here, not a donut shop. Well, because DRU is not in the surf shop business, these would not be considered ordinary and necessary expenses. So this means that if DRU ends up in the surf shop business, these would be startup costs, and we would treat them as the same as other startup costs under 195, $5,000, $50,000, etc. If, on the other hand, DRU does not end up in the surf shop business, then what would happen is these costs would have been capitalized, right? Because we would have capitalized them under 195 or this other version until such time as we've decided that the investigation is a failure, and at that point the corporation would deduct those as a loss. Note that this is different between corporate and non-corporate forms. If you're a non-corporate taxpayer, those are not deductible at all. They're just personal costs and you would never deduct them. But at least in the corporate form, since corporations are largely thought to be only engaged in trade or business activities, you just capitalize the costs and take them as a loss as opposed to dealing with startup costs in some other way. All right. So some other matters is that corporations file on Form 1120. It's generally due the 15th day of the fourth month after year end. So for a calendar year end corporation, their 1120 is due on April 15th. If you make the S Corp election to be treated as a pass-through, then now your tax return, your 1120S, is due 1 month earlier, so the 15th day of the third month. And all these different forms can file for an automatic 6-month extension. Automatic doesn't mean you just get it. It means that you still have to file your extension form, but you do not have to provide a reason. And I definitely remember a day back in the 80s when I did tax compliance work where we had to put a reason on the extension form and then wait for it to come back approved from the IRS. We used to just put need additional time to collect books and records. That's what everyone put. And finally, the IRS realized, wow, that having someone provide a meaning is meaningless. Okay. So corporate estimated tax payments. So like all taxpayers, individuals as well, you're not really allowed to pay your taxes on the date you do your tax filing. Instead, you're supposed to either make estimated payments during the year. Well, for corporations, you make estimated payments during the year because there's no withholding system for corporations. So they're due on the 15th day of the 4th, 6th, 9th, and 12th months of the taxable year. So again, if you're a calendar year corporation, April, June, September, and December. And this is important to note that, look, these quarterly payment dates occur, except for the first quarter, prior to the quarter actually closing. So again, if you're a calendar year end, if your second quarter tax payment is due on June 15th, you do not close your second quarter until June 30th. And when we talk about the form of annualized income payments, this is going to become relevant. So there's an exception if your tax liability is less than $500, you don't have to make estimated payments. But what happens is if you do not make these estimated payments, they can impose a penalty on you, the underpayment penalty for not making payments on a timely basis or making them insufficient in amount. And the way you avoid the underpayment penalty, okay, so there are 3 exceptions, although the first one isn't really an exception. So the first exception is you pay 100% of the tax that you owe. Well, of course, if you pay 100% of the tax that you owe, you don't have an underpayment. So I'm not sure why they classify that as an exception. There's just no underpayment. Exception 2 is if you pay 100% of prior year's tax liability. So let's say that you're a growing company and you're not really sure what your tax liability is for the current year. You have a safe harbor that says, well, look, as long as I paid as much of the tax that I had last year, I'm okay. And then the third exception is that you pay 100% of your tax based on an annualized estimated income method. And we're going to get there. But that's basically saying, look, we understand that you don't know exactly what your current year taxes are because we're asking you to make these payments before year end. So as a result, we'll design an estimation system for you. And as long as you follow that estimation system and pay taxes in accordance with it, will allow you to not be subject to penalty. So that second exception on prior year, that's only available, of course, if you had tax liability in the prior year. So if you're a new corporation, that doesn't work for you. Or if you were, in fact, in a corporation last year but you had no tax liability, you cannot rely on last year's. The second exception is that if you did a short period return. So if your prior tax return was only for 4 months because you didn't start until April, you, of course, can't rely on that. There's also a special rule for large corporations. So large corporations are defined as those that have taxable income of $1 million or more in any of the 3 preceding taxable years. So if that's the case, you are a large corporation for purposes of estimated taxes. It's amazing how there's 1,000 different definitions of what it is to be a small corporation versus a large corporation. Okay. So the computation of estimated taxes, that exception 2 that says you can use prior year, if you're a large corporation, you may only use that exception for your first quarter estimated tax payment. You cannot use it for the remaining 3 quarters because the notion is, look, if you had $1 million worth of taxable income in any of the 3 preceding years, you're sophisticated enough that we're going to force you to estimate your taxes based on the annualized method. So that would mean that if you're doing so, you make that first quarter payment based on last year. You have to catch up any difference by the second quarter. Okay, so let's talk about this annualized method. So what you need to do is calculate your taxable income for the annualization period. So you have to do that 3 times during the year, right? So that's in April, June, September, and December. So your taxable income for the period is for the quarter prior to that. So in April, that's in March. In June, that's still in March because it's only as of 6/15. In September, now it's as of June, and in December, it's as of September. So when we go through an example, that might be made clearer to you. So that means your first quarter estimate's based on 3 months, your second quarter estimate's based on 3 months, third quarter on 6 months, and fourth quarter on 9 months. And yeah, that's not intuitive, but that is in fact the way it works. So you calculate your taxable income for that quarter based generally on your typical taxpayer's method of accounting. So if you're accrual based, you would calculate your estimate based on accrual based. But there are some bizarre exceptions. So there's a list of things that it simply makes sense to spread them out during the year, regardless of when you incur them otherwise for tax purposes. So for example, real property taxes, often the county only bills you twice a year, but you should spread those costs throughout the 12 months of the year when you're doing these annual estimates, because of course it makes sense to do so. So if you make a payment only in the second and fourth quarter, in the first quarter, that would not be part of your taxable income calculation. So what they're saying is, no, you need to accrue part of that cost back into your first quarter when you're determining what taxable income is for the first 3 months of the year. And they're saying the same thing would be true of bonuses or charitable contributions that are deductible after year end, which we'll talk about that later and actually we've already talked about it, and the recurring item exception or the 12-month rule. There's a couple other special rules we're not going to dig in too deep on. If you really want to understand those, the regs cover those under 1.6655-2 F and G. Feel free to read those at your leisure. Okay, so again, the required payment amount. In the first quarter, it's based on 25% of the tax on your annualized income. Second quarter, 50% of the tax on your annualized income. Third quarter, 75%, fourth quarter, 100%. So what that means is you take your first quarter's activity, you extrapolate that out to what it would be if it were over the year, you calculate your tax for the year, and then multiply it by 25%. That's very different than taking 3 months worth of income and multiplying it by the tax rate. So of course, with each payment, the subsequent quarter's payment reflects what the annualized tax would be minus what you've already paid. So in each instance, except for the first quarter's payment, you deduct payments you have already made. Okay, let's just get to an example. Maybe that'll help. So last year, P Corp, which is a calendar year end, and they're large, had taxable income of $2 million, and last year's tax liability was $680,000. Although for some reason I think I changed that later on in the example. We'll find out soon enough. So they need to prepare estimates of their taxable income. So for each of their estimated tax payments, one in April, one in June, one in September, one in December, they determine the number of months they need to calculate taxable income for. So again, in April, 3 months, in June, 3 months, in September, 6 months, in December, 9 months, because those are all due prior to those quarters actually closing. So they've estimated their taxable income as $1 million at the end of the first 3 months of the year. They annualize that and say, okay, my annualized income is $4 million. Okay, so now 6/15 rolls around. I'm at 6/15. I say, well, I'm not through 6/30 yet. So I use the same 3 months worth of taxable income. That's $1 million. Multiply that by 4 again. My annualized income isn't $1 million. It's $4 million. Whoops. Then I come to September 15. I only have 6 months worth of actual results. So I calculate my taxable income for 6 months. I multiply that by 2. My annualized income is $6.4 million. Now I'm in my December period. I only have 9 months of actual results. So I calculate taxable income based on those 9 months. I annualize that. I get $5.3 million. Okay, so now I've done my annualized income calculation. So the next step is to determine what is my actual tax and what is my tax payment as a result. Okay, so we decided that my estimated income was $4 million in the first quarter. So based on last year, I would owe 1 quarter of $680,000, because remember that was my tax liability last year. Based on this year, I take that $4 million multiplied by the flat rate of 21%. That's $840,000. 1 quarter of that is $210,000. So obviously I want to pay the lower of those two amounts because I always want to conserve my cash. So I pay $170,000. Now the second quarter rolls around. So here I am, it's June 15th. I'm using the same estimate of taxable income based on the first 3 months. I can no longer rely on last year because I'm a large corporation. So throw that one out the window. $4 million times 21 is $840,000. times 1/2 of the year, 50%, that's 420,000. So the tax rules say at this point I owe 420,000 of estimated tax payments. Well, I've paid 170,000 already, so my second quarter tax payment is 250,000. In the third quarter, here we are, it's September 15th. So I only have 2 months of actual results. Recall that my 2-month estimate was 6.4 million. Multiplied by 21% is 1.344 million. Times 3 quarters is $1 million. Less what I've already paid of 420,000, right? So that's my 170 for the first quarter, my 250 for the second quarter, means I owe the government $588,000. And then I get to my last quarter. I have already estimated my taxable income, 5.3 million times 21%, 1.12 million, less what I've already paid in, means my fourth quarter payment on December 15th is 112,000. Right? And so we use this annualized information to make these estimated payments. So at least now I can say, well, look, I used your system, your estimation system. If I make payments in accordance with your estimation system, even when the end of December rolls around, if I'm wrong and I underpaid, you cannot penalize me. So let's think pragmatically about how the IRS would decide to tear apart your estimates. So functionally, everything that happens in here is based on your estimate of taxable income. So as long as you take your actual book income and you do your book to tax adjustments in a reasonable way, you consider those the special treatment of things like property taxes, you've done the best you can do. They are unlikely to penalize you for underpayment. Okay, moving on. Here's what the 1120 looks like. I think we've already looked at an example of this because I've had you do an exercise in class on it. Here's what the M1 looks like. This is where you reconcile net income per your books with net income per the tax return. Let's go back and look at the tax return. I've highlighted a couple lines in red. Line 28, taxable income before NOL deduction and before special deductions. So the special deductions are largely the dividends received deduction. Note that when you reconcile on the M1, you are going to, look at line 10, you're reconciling to line 28. So on nowhere on the M1 are you going to see the DRD or are you going to see an NOL, right? So you're reconciling to line 28. That's different than line 30. Notice that line 30 is true taxable income after those special deductions of the NOL and the DRD. So just make sure when you're reconciling your M1, you're using the right number. So the M1 suffers from too much aggregation, right? That was the complaint on the part of the service, even though you often would attach schedules beyond what the M1 was, and you just say, see attached statement. So they developed the M3. And the M3 has a page for income, it has a page for deductions, and you can see that what's happened is we've blown out the number of lines. So now we're forcing taxpayers to comply with the M3 by making them provide much more detail. And the idea was originally that was going to help identify book tax differences under the notion that that would help with audit. Okay. So what is the primary goal of management with respect to net income? Right? So this is their earnings per share, and that's, of course, maximize earnings per share. However, the primary goal of management with respect to taxable income is lower is better. So I have one where higher is better, and I have one where lower is better. And the idea on the IRS was that that friction should be exploited because tax has many fewer instances of deferred income and accelerated deductions, whereas GAAP has fewer instances of accelerated income and deferred expenses. So when I see book tax differences, that might reveal aggressive tax positions, and those should appear on either the M1 or the M3. The other place they might appear is in a financial statement disclosure, which is now required since Sarbanes-Oxley on uncertain tax positions. So FIN 48 said we're going to make you identify uncertain tax positions and we're going to make you talk about them. So the problem is now I've got this information, it's in my financial statements. Financial statements are subject to audit, which means my auditors had to get comfortable with what I disclosed as my uncertain tax positions. Well, that means that information is hidden in the audit work papers. So the IRS has consistently followed what they describe as a policy of restraint with respect to tax accrual work papers. So even though there's a pretty good chance there's some nice detail in audit work papers, the IRS says that only in unusual circumstances will they request to look at those. One of them is definitely when the taxpayer is involved in a tax shelter. Okay, but otherwise, auditor tax accrual work papers should normally only be sought when such factual data cannot be obtained from the taxpayer's records or from other third parties, and then only as a collateral source. They should be requested only with discretion and not a matter of standard examination procedure. So the good news is to try to keep the audit independent and the work papers independent. The IRS follows a policy of restraint. So the IRS commissioner years ago wasn't exactly really happy with that. And so he said, I have an idea. Why don't I make certain businesses that are large enough prepare a schedule of uncertain tax positions? We'll call it Schedule UTP. So Schedule UTP is another tax form that's required for U.S. filing purposes for corporations, I should say, that issue audited financial statements and have assets in excess of $10 million. And the corporation has taken a tax position on its U.S. federal income tax return for the current year or prior year. And there's some form of reserve on their books for that item. Okay, so the idea was, hey, anything you put in your uncertain tax position, we're going to force you to disclose on Schedule UTP. So in March of 2018, the Treasury Inspector General for Tax Administration, or TIGTA, released a report on the use of Schedule UTP. And I'm going to read it to you, so you can either read along or you can stop paying attention, whatever's important. So the report said that Schedule UTP does not contain sufficient information to allow the IRS to achieve the original goals of its use. The lack of detail and specifics related to the concise description of the reporting tax provision provide little more than a confirmation that the certain issue exists, which they knew already. The weaknesses in the form provide for limited use by examiners and group managers in the field and by large business and international division management and executives to strategically use the form during inventory identification and delivery. And that inventory is tax position inventory. It's not, widgets. Without changes that would expand the details reported on the form, such as requiring more detailed descriptions of the reported tax position or dollar amounts of disclosed positions, the expectations of goals in implementing Schedule UTP will not be realized. Okay, so basically they're saying, look, valiant attempt, not really working. So the recommendation by TIGTA was either get rid of UTP or figure out a way to make it work better. And of course, the IRS adopted the latter. It said, no, we're not going to throw it away. We're going to see if we can make it more useful. So I think we can expect changes to UTP over the next upcoming years. All right. So even though typically I like to give you an hour's worth of lecture, today ends at 33 minutes. I appreciate you watching, and I will see you in class.